It's the season of NFOs. It pretty much continues, and the latest entrant with their first equity-focused NFO in that sense is Trust Mutual Fund. They've launched the TrustMF Flexi Cap Fund. The NFO is on even as we speak, and the CIO of TrustMF, Mihir Vora, is with us in the studios today on this very special conversation of the Mutual Fund Show. Mihir, welcome. Thank you so much for speaking with us, and always great to have you here.
Thank you so much. Thanks for having me here.
And especially now, as you embark on this journey, you guys are known for your fixed income products. Why the move to equity now?
Sure. So while Trust Group is known for, the fixed income piece because they're the largest non-bank debt brokers in the country, we also have Utpal Seth as the promoter, who's a doyen of the equity markets. So this is one group which has equity and fixed income in its blood, and the mutual fund, the way the client base is, typically the fixed income client base tends to be more wholesale in nature, larger ticket size, and the retail piece is in the equities. So obviously as a mutual fund, you do want to be a good retail brand. So this is our foray into building a retail brand for ourselves with the equity product.
But then again, the question about why not now and why not earlier, when you've had, like I said, the season of NFOs continues. There's been a whole spate of them. Everyone's been coming in. A lot of new players also coming in. So can you tell us about the timing?
See, it's never a bad time to buy equities, as we know. One can start in a systematic fashion. And we are here for the long term. There is no hurry for us. So we'll build this in the right way with the right people in the right philosophy. And we could have debated 1 month earlier, 1 month later, but ultimately we had to launch it. Yeah. And Flexi Cap is the largest category. So you want to start with the most popular category. And yes, while there are other NFOs coming up, most of the existing fund houses already have Flexi Cap funds. So there are hardly any new Flexi Cap funds coming in. So that way, in terms of the NFO market, it's not a very crowded market.
No, fair enough. Now, tell us about the Flexi Cap Fund. And like you said, it's a popular product. So a lot of alternatives there for investors. What's the USP that you bring to the table?
Certainly. So, in any mutual fund or any investment manager, essentially what matters is 3 things. Who are the promoters? Who are the fund managers? And what is the fund philosophy, right? We believe we have differentiation on all 3 aspects. As I mentioned earlier, our promoters, Utpal Seth and Nipa Seth, are masters in equity and fixed income respectively. So the sponsors themselves have 35 years of experience in the markets. They've seen cycles, they're hearing for the long term, they're running successful businesses in the market. So that's, I think, a very unique proposition. Out of 44 AMCs, I can count on the tip of my fingers the number of AMCs which have sponsors with this kind of market background, So that is one big source of comfort. I come with, as far as fund managers are concerned, I come with 30 years of experience, all in institutions, huge experience in mutual funds. For the last 10 years, I was managing large corpus in Max Life Insurance as CIO, again, as a multi-asset manager. And my fund manager, Akash Mangani, also comes with a very rich experience. So I think the first 2 parts, which is the promoters and the fund managers, I think we have a unique combination. And the third part, which is the philosophy, we are growth investors, and we use what we call terminal value investing as our North Star. So while we are growth at reasonable valuations kind of investors, but our North Star is terminal value investing. And that's a very interesting concept, very powerful concept for picking
Explain that.
Absolutely.
Explain that. When you say we are a growth fund and our North Star is terminal value investing, for our viewers, can you break that down as simply as possible?
Certainly, as long as you have time. I'll take some time to,
Yeah, sure.
Because it's a very powerful concept. Absolutely.
Yeah.
So, India is a growth market, right? And mostly we want to buy growth. So there are many kinds of growth investors, pure growth investors, GARP investors. We stand for what I consider as GARV investing, which is growth at reasonable valuations. I deliberately didn't use the term P, price, because to me price denotes a bit of cheapness. It's more of a change in mindset, where for me, for us, growth is a prerequisite. So we want to see profit growth in a company, see and do the projections for the next 5, 10 or more years, arrive at a value of those profits today, and then test whether the market cap is cheaper than that valuation or not. So to me, growth comes first, and then I test for cheapness. In GARP, typically you would want to see something which is cheap and then test whether it's good for growth. So it's more of a mindset change, I would say. So I'm more comfortable using GARV because we start with growth first and then see whether the stock is available at reasonable valuation. So that's one. Second is, as I said, since India is a growth market, there are always new stocks and sectors emerging which grow not for 2, 3, 5 years, but they grow for 10 years, 15 years, 20 years. The profit growth, the high profit growth phase does not end at 5 or 7 or 10 years. It lasts for 10, 20, 30 years. And we've seen multiple stocks across sectors, across industries doing that. And it does not even have to be micro caps or small caps. Even large caps have compounded for long periods of time in terms of profit growth. What happens is that we are comfortable as analysts and fund managers predicting the near future. So typically when we do our projections, it's for 3 years, 5 years, maximum 10 years. That's the forecast period. The problem is that in high growth stocks and sectors, when you actually do the stock valuation, the valuation of the profits beyond the 10th year is far more than the valuation of the profits in the first 10 years. So the growth rate that you assume after the 10th year is the terminal growth rate. And the value of the profits which come in the 11th, 12th, 15th, 20th, 30th year is the terminal value of the company, which is because you are assuming a certain steady state. Typically, when we say a stock is in a high growth phase, we would say, yes, it's growing at 30, 35%. It'll continue to do that for the next 2, 3, 4, 5 years. Maybe after 3, 4 years, it'll not sustain 35, maybe it'll go to 25, then 20, 10, 15. And then beyond 10th year, typically all DCF models, all profit models will take GDP growth rate.
Right.
So 5% or 7% as a terminal growth rate. That's where the biggest mistake happens, because in these stocks and sectors, the high growth ones, which have a long runway of growth, they continue to grow at 15%, 20%, even 25% in some cases.
So to put it simply, you are picking stocks which have a long-term focus and will really start delivering that terminal growth rate, as you call it, after year 10.
No, that's the biggest mistake that we make. I'm saying, Mr. Market, you are expecting the stock to do well in the next 1, 2, 3, 4, 5 years. I agree with you, right? So I expect the stock to deliver in the first 2, 3, 4, 5 years, like the market does. But what I'm expecting is that the runway of growth will not end at 10 years. It'll go on for 10, 15, 20 years, which means that the value that the valuation that I'm willing to ascribe to the stock is far more than the market expects. So when I buy the stock, the same stock with the same 2, 3, 4, 5 year horizon, I will buy larger quantities with far more conviction, and I will hold it for longer, because I know that this is not a 5-year story, it's a 15-year story, it's a 20-year story. So my conviction is higher, I buy bigger quantities with higher conviction, my holding period is higher, because I don't sell it when it goes up 50% or 100%, I hold it for longer. So we are not compromising on the short-term returns. It's just that you're looking at the bigger picture and buy with much more conviction for a longer period of time.
That important line, because for investors right now, of course, for mutual funds, you have to invest for longer term. But how will you ensure you're not compromising on short-term returns? Remember, in the last few years, investors have gotten used to seeing some phenomenal returns.
Absolutely.
And you're doing a flexi cap, of course, but in your small mid-cap kind of funds have had eye-popping returns.
Absolutely.
So what is that returns proposition?
The returns proposition is compounding. So we will make money in the short term, and we'll continue to make money in these stocks in the longer term too. That's the proposition. Because typically, as I say, you make 100%, 200%, you think it's done, right? But if you have a firm view that this trajectory, this runway is far longer than 5, 7 years, then you will hold on to the stock and ride the full upside. You are talking about not 100% upside, 200% upside. But if the profits compound, then the stock continues to compound.
Okay, tell me about the breakup. When you say a flexi cap fund, I think 60 to 100% in equity. That's what you're going for?
That's equity, and it can be 0 to 100% in any of the caps.
What are you starting off with? Do you have an idea in mind based on what you're seeing in the market right now?
Certainly. So, just to give you a lay of the land, in my view, there are 5,000 listed stocks in the market, right? And if you do some kind of a basic filter of market cap, quality, etc., relevant stocks are about 1,000 stocks. Out of those 1,000 stocks, the top 100 are large caps, next 100 are mid caps. There's a tail of almost 700 stocks. If I look at the market cap breakup, it's about 313 lakh crores of all these 1,000 stocks put together approximately. If I do a breakup of sectors into high growth sectors and the other sectors, out of these 313 lakh crores, about 30%, which is about 90 lakh crores, is in high growth sectors. But the fun part is that if I break up this 90 lakh crores of high growth sectors into mid, small and large, then approximately 70% of this 90 is in mid and small. So when I'm buying into India as a high growth story, my choices are naturally more in the mid and small cap segment. So my guess is that all things considered, given valuations, etc., about 50% of the portfolio should be in large cap, 50% thereabouts, and 15 should be in mid and small caps at this point in time for our portfolio. That's what it looks like.
And what is your filter looking like? It's clearly not going to be sectoral, etc. But then what are the other filters you're applying in terms of what will work in a long-term perspective for investors?
So first and foremost is the quality filter. So the management background. That's the first, if you don't trust the management, you don't buy, as simple as that. And second is, the growth aspects. We should be buying into sectors which are expected to grow, at least in the short term and preferably in the medium term also. So these kind of stocks where I described, the runway can be 10 years, 15 years, 20 years, those are not easy to find, right? So
valuations are high right now.
No, even if valuation,
you're saying don't worry about price,
no,
but
absolutely.
things are pretty pricey.
They're not easy to find. No, even if you ignore valuations, to have a firm view on a stock that is going to grow for 20 years or 15 years is not easy, right? You really need a longer term conviction on that sector or stock. So my guess is my portfolio will be 40 to 60 stocks, let's say 50 stocks, out of which 15 stocks would be ideally stocks where I have this level of conviction, where I will buy, in a good active way, good weights in those stocks. The balance, the 35, 40 stocks would be stocks where I would follow the GARV, where we have a view on growth, but not a 10 or 20-year growth, maybe like the usual 3, 5, 7-year kind of a prospect. So that's what it broadly looks like.
I'm wondering, is the stress test on your mind when you are picking now? And I'm asking this question because you're launching an NFO after this whole thing has hit the market.
Certainly.
Everyone came out with their first cut of stress tests. You're going to have to present yours. Does that become a factor while picking?
Not for a fund of our size. We're still starting from a low base.
Fair.
So liquidity for us should not be that much of an issue. I'm hoping that I get to that size that I have that problem, but not yet.
Yeah. Okay. Fair enough. Would it also say that small and mid cap perhaps need not be the focus area, at least to go first up? If you're saying 50% is likely to be large caps.
Absolutely.
So can I extend that to say that right now you're a little circumspect on how much more small and mid caps can give from a longer term perspective?
No, it's not that approach. I'm not doing a top-down allocation to large, mid, and small. But we have a very good presentation. It's there on our website. Please do go through it. But one of the slides, it clearly shows that the kind of stock that we looked at, long-term compounding, does not have to be only in mid and small caps. We've seen examples after examples, and we started from the year 2006 for our study. We've seen examples after examples where the stocks which were large at that point in time also compounded at 20-25%.
Understood, Mihir. And of course, I understand that's in your presentation. The question that I'm asking you is that right now, looking at the run-up, looking at the valuations, looking at the concern over small cap run-up recently, some funds also went as far as to curtail your lump sum investments, etc. Would you be of the view that the safer, better, longer-term bet lies with the large caps vis-a-vis the small and mid caps, which has, may I add, caught the imagination of investors?
No. If I were to first of all, I'm very cagey about making a blanket statement on entire large cap bunch or entire mid cap bunch or entire small cap bunch. Okay, you should look at it stock by stock. There is enough scope for stock picking. But if I were to force myself and give a view, I think valuations in large caps are far more reasonable than the next 150, which is the mid cap. The small cap segment, the fun is that it's so large in terms of number of stocks that there are 700 odd stocks out there to pick from. So there, it should be possible to find, those 20, 30 stocks that we are talking about. Large caps in general, we expect profit growth of about 15% for the next couple of years, which is a pretty good profit growth. And if that happens, then valuations at 20, 22 times is not that expensive.
Okay, last question now, not only with the CIO cap on, but even market watcher. And we're seeing what's happening with markets right now. Fantastic run-up rally. What are the sectors that you're liking?
I continue to like the domestic theme. First of all, the three themes that we like are consumption, but within that, premium consumption and financialization of savings. So I think everything in the long term which has to do with premium consumption should do well. That includes premium real estate, premium cars, jewelry, eating out, travel and tourism, leisure. That I think is a demographic tailwind that's going to last for a long period of time. And along with demographic rising income levels come financial lifetime savings. So we are not only talking about banks, which anyway are there, but within the space of financials, we are talking about capital market linked stocks, wealth managers, AMCs, insurance companies, those kind of names, which will grow faster than the rest of the financial services. So that's one thing. Second is again a domestic theme, which is physical asset creation, manufacturing, infrastructure, real estate. Those will have to do well for the economy to grow at 7%. Without the physical asset creation theme, we will not grow at 7%, and I think we are on our way there. And third is, I think, emergence of digitization and new tech companies, the new business models, disruptive business models. Those, I think, also have a good runway to grow.
Yeah, absolutely. Thank you so much, Mihir, for coming down and speaking about the new, new fund offer that Trust Mutual Fund is going to get. Rushabh, hi, great to have you on the show. We're going to talk about a couple of things today. One, of course, the TrustMF NFO, which we spoke with Mihir about. Is it a good take for investors or not? But interestingly, we're also speaking at a time when mutual fund data for the month of March is out, and I'm quickly going to take my viewers through it. So the net outflows. We've seen net outflows in the month of March for the industry at 1.59 lakh crore rupees versus inflows of 1.18 lakh crore rupees month on month. That's a bit of the tide changing. Remember, this could be a result of the stress test results which were declared by mutual funds after SEBI regulations last month. Net AUM, asset under management of the mutual fund industry, has resultantly also dropped very slightly by 53.4 lakh crore rupees versus 54.54 lakh crore rupees month on month. This is interesting. Small cap funds have seen an outflow for the first time since September 2021. Take it back to the point I was making. You saw stress test results, and while they have no real life bearing on what happens with the performance of those small cap funds, it seemed to have caused at least some panic. Flexi cap funds have seen a net inflow of 2,738 crore rupees in March, while large cap funds have also seen a net inflow of 2,127 crore rupees. So have mid cap funds seen a net inflow. So the only place where you're seeing real pain seems to be in the small cap funds, which was perhaps expected as well. But let me quickly go to Rushabh for a take on this. Rushabh, let's start with any hot take you have on the Amphi data, if any. Is that sort of hesitancy in small cap funds something that you're observing as well?
Tamanna, good afternoon. Thanks for having me on the show. As you clearly mentioned that, we have seen a good amount of outflow after a very long time in the small cap space. I am absolutely not surprised by the outflow because it's very natural of all the, halla gulla what is going, especially in terms of the stress test, and a lot of people are talking about valuations and the liquidity issues in the mid and small cap space. So I'm definitely not surprised that some kind of profit booking was very much natural and very much needed as well. So if we go to see the overall, the breadth of the market seems to be very good in terms of liquidity. And of course, we have touched 75,000, in the past a day or two. So, I think it's very natural to have some kind of outflows, and I think it's healthy as well. I'm really expecting some kind of valuation or a price correction in the mid and small cap space, because it gives because the number of people who are coming in the mid and small cap space have been quite large in the past year and a half. So I think this is something very natural and healthy in my humble opinion.
Okay, so this is healthy and natural. Rushabh, what we're also talking about on the show today is the new offering from Trust Mutual Fund. We had an extensive conversation with Mihir Vora in segment 1 on their new fund offer. It's the first foray into equity for this fund house. What would be your advice to investors looking at it as an option? Again, they're coming in a flexi cap, multi-cap kind of an product line, and several of those available in the market. Why should this one be a choice, if at all?
Tamanna, I was just hearing to what Mihir had to say earlier, and I won't go too much into the nitty-gritties because he explained it quite well. Overall observations from the presentation are, the senior management team is very well experienced, very well seasoned. I don't see any issue over there. The mentor of the group, Mr. Utpal Sheth, and of course, Mihir Vora, the CIO, needs no introduction in the capital markets. They are going to follow a more of a growth-oriented strategy, but of course, there will be a flavor of value as well in the product. I think because growth overall has underperformed since past 3.5 years, so it's high time once the interest rate cycle, when the RBI starts the interest rate cut cycle, I think the growth strategy will come back to its mean reversion and come back in action. I think that could be, favorable for the fund. And as Mir also mentioned that he and his team are planning to allocate around 50 to 60% into large caps. What we have seen as large caps valuations have been also quite reasonable and has underperformed mid and small caps over the past 3 to 5 years. So I think the growth strategy and large cap allocation can do well, in the short to medium term for the fund. But now here's my take. See, currently it's an NFO. They are starting new, right? So I wouldn't recommend investors to invest in this fund right away. I would like to wait and watch, for at least 3 to 5 years, how the fund performs. Although the management is seasoned and well experienced, I would still like to wait and watch how the fund performs in the market. Also, I would like to see, how the fund strategy also pans out to be, how they are churning their portfolio well. Because in today's time, I think, buy and hold may not be the right approach. I think a little bit of churn is also equally important if you want to make, decent returns over and above the index. And also, how well they are managing the downside and the upside. I think these are the few points I would like to observe in the next 3 to 5 years of this particular fund.
Yeah.
See, there are many existing flexi cap funds with very well proven track record. They have shown greater than 90% outperformance strike rate on a 10-year daily rolling average, 10-year daily rolling returns. So I think sticking to existing flexi cap funds is something what I would recommend investors to do.
Okay, so wait and watch and see how their strategy unfolds is what Rushabh is saying as far as the TrustMF, new fund offer goes. I think we have time to take one query because we don't want to leave the show without, taking your queries, our viewer queries. So let me take this one from Harsh, who's aged 20. The goal is lump sum return, says I would like to invest 2,000 rupees a month as SIP in a few funds for a time horizon of 40 years. Can you recommend funds to start building my portfolio? First of all, Harsh, congratulations. At the age of 20, if you're thinking of investments and, a 40-year horizon, already you're on top. I don't think any of us were thinking of this when we were 20. So, Rushabh, having said that, how should Harsh start off?
Tamanna, absolutely. I too want to congratulate him. It's very mouth-watering to see a 40-year time horizon, so you can imagine the magnitude of compounding effect in this 40 years, even with a very small amount.
Yeah.
So first of all, hats off and congratulations to him. He has a very focused mindset at the age of 20. So I think since he's a first-time investor and he's starting with a small amount of 2,000 rupees per month, I would suggest him to go for a Nifty 500 index fund, which constitute the top 500 companies of our country, as per market capitalization. Around 70-75% would be allocated in large caps, 20-25% into mid caps, and 5 to 10% into small cap. I think that will be a good start for him just to taste the SIP methodology and taste the equity markets. Two things I would additionally suggest him to do is number one, try to do an SIP top up of around anywhere between 10 to 15% year on year, as and when his income increases. And secondly, when he decides to increase his SIP amount, he can definitely venture into other active products like flexi cap funds, mid cap funds, and small cap funds as well. Because over the longer period of time, what we have seen is that mid and small caps have generated much higher returns compared to the large caps. But to start with, Nifty 500 index fund is something what he can look at, and then venture into flexi cap, mid caps, and small cap funds.
At 20, the world is your playground, Harsh. So first of all, you've already won the battle by starting off so early. That's all the time we have today, though. If you want to write in to us, the numbers on your screen. Rushabh, thank you for taking out the time and joining us on the Mutual Fund Show today. That's all the time for now, but we're back here, same place, same time through the week. Stay tuned for that, and a lot more coming up on the other side.